A lot of people say Google has a strong moat. For example, high quality Google search. Almost the whole world uses Google search for their search needs on the internet. If somebody were to tell me that Google's moat in 2 years' time would be a lot weaker than it is now, I actually wouldn't be surprised. I actually met him through one of the Motley Fool forums boards, and I found out that he had an incredible track record of over 30% CAGR over the past 40 years. So
today's guest is my friend Cedric Ho, an investor with real passions for uncovering great companies and helping others grow their wealth. He graduated Cornell University in Mechanical and Aerospace Engineering. This one literally is rocket science, and later taught his wealth management class at SMU. Cedric started out investing his own money, now manages funds for others. He's known for constantly refining his thinking and believes in growing portfolios through performance. Beyond investing, he's also big on giving back and making financial educations more accessible for both adults and kids. Welcome, Cedric, to my channel.
Hey, Bunti, glad to be here. Thanks for having me.
So I'll just kickstart with asking, you are now managing funds professionally, meaning you are regularly monies from someone else and manage those, right? So can you walk through with me, like, what's your journey to this point? Because I know that before this, right, you are not investing others people's money. You are just working as an employee. Then you kind of like retired, semi-retired. So how do you end up like now suddenly go back to managing money for others? Can you walk through with me your transitions?
Yeah, sure. I'll be happy to. It's taken me a long time to get to where I wanted to be. So when I was in university, I knew I wanted to go into asset management. But at that time, it was not quite possible because I had just taken a scholarship from the Air Force and I had a 6-year bond to serve. So my career actually started in the military. I was an Air Force engineer. When I finished serving my 6-year bond, I tried to pivot into the finance industry. I found that difficult. Not many people wanted to give me a chance in the finance industry. So I went to take a master's in SMU. At the same time, I also moved into corporate finance, which was pretty close to asset management, but not quite. I moved into corporate finance, specifically M&A, so buying companies, setting up companies from the ground up. Then at one point, my son was really sick. So I kind of took time off from work to, one, take care of him, and second, also to be able to pursue my interest investing full time. So that's when I quit my corporate job and went into full-time investing for my own portfolio as well as for my family's portfolio. So I did that about 8-9 years. And then over about 2 years back, there was this opportunity to be a portfolio manager, to start my own business as a portfolio manager. And so that's when, I jumped at the opportunity, applied for a license with MAS, and then started managing money for other people. So it's in all, from the time when I wanted to be in asset management, it probably took me just over 20 years to get to where I am right now. So it's been a long journey, but I'm glad to finally be here.
Actually, you are interested with investing since long time ago, right? Why didn't you just choose a degree that is closer to asset management? I know there's no degree in asset management, but there's always degree for, let's say, like business administration or some finance related degree, right? Which makes you closer to financial industry. Why choose a degree that is in engineering, which is, I would say, quite far away from investing?
Yeah, I think for me at that time, when I was 18, looking at what to do in university, it wasn't so clear yet. Most people don't really know exactly what they want to do at that age. So there was a lot of encouragement from the government to do engineering, especially for students that they were keen to offer scholarships to. Really, engineering was kind of the only option. It was only maybe until the second year of university where I took some finance classes. And for that, I'm glad that I went to the US for my university education because they believe in a more broad-based type of education. So when I took finance classes, that's that's when I realized that my passion truly lied in finance. And of course, investing classes, business classes were a lot easier than 300, 400 level engineering classes. So I kind of naturally gravitated towards more finance related classes. But at that time, I didn't really have a choice.
Having studied all this engineering and rocket science, right? Do you think this kind of like skill, let's call it like generally like engineering, do you think it is helpful in terms of you building up your knowledge and building up your investing skill? Like, is there any part that is transferable, or would you recommend someone who is really interested with investing to straight away go to investing rather than go through some other routes? What kind of advice will you give?
I think engineering allows somebody to be trained in a certain way. So, for example, engineering, it's very methodical in the way you do things, a bit like mathematics or science. First, you do step 1, then followed by step 2, step 3. So I think engineers tend to be trained in a certain way to do things very methodically, but at the same time, they also think of things in a very black and white manner. It's either right or wrong. Like if you answer a math questions or calculation questions, there's really no partial marks if you get the answer wrong, right? Generally. So I think there are pros and cons, but I think the good thing about engineering is it allows me to think in steps, and that I found very transferable to the investing world.
It seems that after having like some pause in your career and now you go back to managing money for people, it just shows that you are deeply passionate about investing. So can you share with me what drives your passion for investing, sir? What is about this world that excites you or motivates you personally?
I was introduced to the world of investing when I started reading this book called Rich Dad, Poor Dad. I think you have probably read that book. Many people have read that book as we were growing up. And I think one of the key concepts in that book was financial independence. And that really resonated with me. There are many ways to achieve financial independence, right? In the book, it talks about getting a high-paying job, an extremely high-paying job, for example, like doctors, lawyers, to build up your wealth to reach financial independence. Of course, you can also marry into a wealthy family to achieve your financial independence. The one method that really spoke to me when I read the book was achieving financial independence through investing. I liked the fact that it was somewhat intellectually challenging. And right now, I think what really continues to excite me is this desire to find stocks that have the potential to be multi-baggers for my portfolio. And of course, now that I'm managing money more professionally, it motivates me. My investing motivates me from the perspective of not wanting to let my investors down. I mean, a lot their money is hard-earned capital, which they have certain goals, certain financial aspirations they want to meet. And the last thing I want to do is to let them down after they entrust money.
Just to share with you, this I recall, right, this book is considered the first book that I read. Right? Before I read, I mean, of course, don't talk about school, those school textbook, of course, we read those. I'm talking about books that we read outside, whether it's fiction or non-fictions, right? Actually, the Rich Dad Poor Dad, I know the reputations of Robert Kiyosaki, maybe, especially in recent years, may not be that great, right? People talk about his company bankrupt or all those things, right? But I realized that actually his book, right, I read it during my university time, and it still affect how I think about like life, like personal finance. Like you want to have a pool of assets that generate, whether it's like dividend yield or rental income, whatever, as long as investment return, and use the investment return to support our expenses and so on, right? Basically, financial independent, right? That part still affect me up until today.
I think what the book did for me was change my mindset. Coming as a student in Singapore, in Asia, you don't really think about these things, and families don't really talk about money, talk about investing and all that, the typical family, right? So I think it was an eye-opener, a mindset shift for me in terms of financial freedom and all that. And I'm guessing it's probably the same for you as well.
Asian family typically don't talk too much about money. Like even let's say, I don't know, maybe later we can chat more about like how do you educate your kids, right? Because sometimes kids, they ask questions that is very simple. For example, like, are we rich or are we middle class? I mean, this kind of question is like, okay, you usually I think Asian family tends to, how to say, divert the attentions instead of like us directly answering the questions, because we are not used to have these kind of conversations. I think that's quite typical. I'm not saying all Asian families, I'm just saying typically if we are not into those conversation that much.
And I think increasingly that should be an important topic to discuss, whether in which instances money is important, investing is important. Of course, it's not always important, and there are things that are more important than money, right? But I think just to have that initial conversation, I'm a bit with you in the sense that we need to start having more of these conversations with our family, with our kids.
We will come back to that later. But first, now I just want to quickly touch on, because for every guest that I interview, right, I'm very interested to know your investment philosophy, your portfolio. What is the top companies in your portfolio? Just to help me understand what is your investment philosophy, your investment style that you lean towards.
That's a question that I think has a very long answer to it. So I'll try to best answer it as best as I can. Basically, I would consider myself more growth oriented. I look for companies that have good revenue growth, good earnings growth. And basically my investing is based on a very simple mental model, which is basically when earnings and revenue grow, then the value of the company increases. And more often than not, this is reflected in the share price. So for me, this is a good way of growing wealth for myself as well as for investors.
If I just look at your investment criteria, by the way, this one I pull up from, I think, your website, okay? Because when we read that, right, it is generic enough, because it's hard to argue the other way, right? So for example, you say you invest in quality companies, right? Companies that demonstrate strong competitive advantage, have strong business model, but nobody will say I invest in companies that don't have good quality, right? And you mentioned that you invest in companies that's like demonstrating growth, but I have never seen anyone say that I invest in companies that don't show growth. They are deteriorating ones. So there's no way to argue the opposite way, right? Like great management, how to argue against it. So maybe it's helpful for you to give me, like, let's say 1 or 2 companies. We can talk about, let's say, company that I think last time we talked about companies called Git, right? That's the only one that I remember. Then the other tools maybe is Hims and Robinhood, right? Maybe we can choose either one of these and let me know, like, what are the criteria or how do you choose these companies? What are the things that you try to spot and try to understand? Maybe start from some of those, the story on how you uncover those companies. That would be helpful.
I mean, since you mentioned my website, I'll just take the chance to share with your viewers that my website is at www.madpartnership.com. And basically my business is called Mad Partnership. Mad stands for Make a Difference, where I hope to make a difference for the financial futures of my investors. Sorry, sell a bit of koyo for my website. But so you talk about the information that's captured in my website. I think you're right to say that it is pretty broad, and I think it is deliberately broad. The reason for that is because I find that investing is a very fluid process. I constantly hope to improve myself as an investor, and who I was, say, maybe 3 years ago as an investor is very different from who I am right now as an investor. And I hope that in 3 years' time, I'm going to be very different as an investor, better as an investor. So I don't like to pigeonhole myself a very specific styles of investing, because then I think it doesn't give me the space to grow as an investor. So what I'll share with you now is, yes, if I say I invest in quality companies or invest in growth companies, you might say that no one will say they wouldn't, right? No one will say I'll be investing in a poor quality company or investing in a low growth company. But then you'll be surprised at how many people actually end up very low quality companies, or maybe low PE or low PB companies that are not necessarily growing. I mean, there are many different styles of investing. Yeah. So I think it's one thing to know your criteria, which I spelled out on my website, and it's another thing to be able to identify the companies that adequately meet your criteria. And I think that's the difficult part for many investors. I think these usually come with experience. So I'll give you an example when it comes to quality. A lot of people say Google has a strong moat, for example. High quality Google search. Almost the whole world uses Google search for their search needs on the internet, right? And I think anytime within the past 15 years, if you were to analyze Google as a company, you would say it's a pretty high quality company. But I would say if you look at Google right now, I wouldn't necessarily conclude it's of the highest quality in terms of mode, because AI and ChatGPT and all the other tools are changing the landscape or changing the way in which we conduct search on the internet now. And I would say there's a high chance that maybe 1 year or 2 years from now, Google's mode or quality may no longer be as strong as it was 2 years back, right? So this is an example of how it's maybe quite common sense to have all these criteria, but how you actually apply your investing when it comes to these criteria, I think matters a lot. And that separates for me the good investors versus the not so good investors. Sorry, I went a bit maybe off tangent. I don't know.
I want to respond on the Google one since we are here. So you are saying that the quality part, right, is more subjective, right? It's not so much about
Very
like I look at ROIC, high quality, high ROIC. So if it is low, it is low quality. It's not as simple as that, right?
I don't think it's as simple as that.
Okay. Then come back. Google one want to go slightly more into details, because I can always argue the other way around. Like say, for example, let's say I'm Google Bulls, right? I would say that you talk about all the ChatGPT influencing how people search for information, but yet Google, they have their Gemini model, which arguably isn't too far away in terms of the model quality. Maybe in terms of traffic, they are behind. You can attribute that to the branding associated with ChatGPT, because they are the one that popularized all the AI LLM, right? They are considered the first one with ChatGPT, basically GPT-3 back then. So Google still have their Gemini, and anyway, all these AI, they will still rely a lot on cloud computing. And Google, together with Amazon, AWS, and also Microsoft Azure, right? Google, they also have their cloud business. So anyway, they will benefit from all this growth of AI cloud server, right? So this is another point. The third point is that I borrowed from my friend. He said, ChatGPT is already with us for, maybe 2 or 3 years already, right? If we look at Google's financial statements for the past, let's say 2 years, right? They're still growing. Advertising is still growing. It seems that everything seems to be good, right? We don't see that, okay, the traffic really going down a lot, right? We don't see that, at least till today. Would you debate with me on this point? All these things that I just covered, they're all wrong, or what?
You mentioned a lot of points and I'm just writing them down. All right. I think you bring up really interesting points, right? When it comes to Gemini, I think it's a competitor to ChatGPT. I sometimes do similar searches on Gemini and ChatGPT, and these are free versions. So comparing free versions, and I find Gemini's response not as good. So for example, if I'm looking for a physiotherapy treatment program for an injury I find ChatGPT a lot better in terms of structuring a plan for me, explaining to me why I need to do each of these exercises, whereas Gemini may not so strong in coming up with a treatment plan. I still think at this stage, Gemini trails ChatGPT, and I think in the world of digital consumption, habits form pretty quickly, in the sense that if ChatGPT continuously gives you better results, say for the first few weeks or first few days of you using different AI models, I think you will naturally gravitate towards the AI model that's giving you better hits. And very few people would say, okay, 6 months later, I'm going to try Gemini and see how it is. Habits form pretty quick. So that's what I will say for that. Yes, even though Google does have Gemini as an option, but the fact is they're not monetizing Gemini as much as they are Google search, right? Google search has your advertising revenues and all that. Whereas once you go to a Gemini model, unless you're on a paid plan, I actually don't know if Gemini has a paid plan.
They have.
Because I'm not on it, but I would suspect, they have. I would suspect that the monetization is probably not as much as Google search at this stage, right? So if even Gemini starts cannibalizing some of the search habits from Google search, I would say it may be quite hard for Google to monetize it as effectively as Google search. So that's the other point. And I think you made a third point about revenue revenue still growing well for Google search, even though we've had a couple of years of ChatGPT. Even if there's a new competitor or a new better search function in town, I wouldn't expect previous incumbent, their revenues to drop off a cliff immediately. I would think it will still take some time. And I would say at this stage, Google still has a chance to maintain its dominance. So it's not a foregone conclusion that ChatGPT is going to win the search war. Although I would say that ChatGPT is winning a lot more eyeballs over time, over these past 2 years. Of course, if you look at it 2 years ago, you can say probably 90% of the search happens on Google search. And now I think increasingly people, and this is more anecdotal evidence that I have speaking with people are increasing their search functions on ChatGPT. Maybe, if it used to be 0%, it's now 5%, it's 10%. Personally, my change happened in the past 3 months, where 3 months ago, I was almost exclusively on Google search. And now I'm increasingly moving more towards the conversational style of search that ChatGPT is offering, because I find that it saves me a lot more time. And I can actually see myself moving more towards that. So I think habits also don't change overnight, although they can form pretty quickly, but the actual change doesn't happen overnight. And it doesn't have to be ChatGPT, right? It can be another search model. And why I say that is I look at how my kids consume the internet nowadays. When they do a search on Google, they don't click into the pages anymore. They expect the answer to be on the page itself when they search. And this is what ChatGPT and the other AI models offer. So if the new generation of users are going to consume data this way, then I would say the conversational style of the AI models are actually much better suited for this new generation of consumers. So these are a few reasons why I think Google, I'm not saying that the moat will erode for sure. We don't know yet. I think we are still seeing it play out in real time. But I can indeed see if somebody were to tell me that Google's moat in 2 years' time would be a lot weaker than it is now, I actually wouldn't be surprised.
I think you brought up very good points because I can't even recall when the switch happened. It's just that actually since GPT came out, I use it quite often. And now if you ask me when was the last time I spent long time to go and Google certain thing and look for the right web page to show me the right answer for anything that I'm looking at, right? I can't recall I've did that. Of course, every day I still use Google, but usually, right, Google is just like a shortcut for me. For example, I already know the website that I wanted to go, but I still click on the Google just to direct me to the right place. But they are so good that they know my search history. They will just usually within first or second, it's like the blue rings, right? I will just go there already. It just direct me to the right place because I don't want to remember the full website names sometimes, right? For example, I want to go to your website, I just remember one keyword, I type, it will show up already. But for any things that require research, right? Actually, I already all into those AI tools. And right now, any trend that we just mentioned, right? I don't think it is matured yet because whoever that's using all this AI, I think you are still considered early adopters. There's still so many people that haven't really used them a lot. And these transitions is just in their early phase rather than matured state.
I think it's going to be a huge shift. You're right to say right now, I mentioned my change happened in the past 3 months. I wouldn't consider myself an early adopter, but also because prior to those 3 months, I didn't feel that the models were good enough to give me the returns I wanted. So I think more and more people will find the AI models better suited for them. And also, like I mentioned, you're going to have this entire generation, I think below the age of 20 years old, right? That's going to come up and be consuming more on the internet, and they are going to be the main generation that shifts that determines how we consume our data and how we search. So I think the shift is going to be tremendous going forward.
But are you still using the paid version, or are you using the free version for ChatGPT, for example?
To be honest, I found the free version to be good enough for me. Like I said, I'm getting treatment, health physiotherapy treatment suggestions on the free version. So I haven't, maybe the paid version might be another step up. I just haven't found the need to move to a paid version yet.
Yeah, you need to give it a try because you were seriously impressed. Because I think the base model is the same. Let's say like the ChatGPT 4.0, right? Free and paid versions, they get the same model. It's just that I think for the 4.0, they kind of limit you after you use it too many times, right? That's the only things. But the more powerful models, I think some of those is really for now only available to the paid user. So that's how they segregate. And those other functions like the deep research, those kind, I think you need the paid versions to do that. So that's AI discussion. It's okay. Right. We move on to other discussion first. Later we come back if we still want to chat on this. But good points on the Google one. So let's switch gear a bit to the other companies. Maybe we can start from, let's say, Robinhood, because you mentioned about this company, right? Maybe just walk me through how do you discover this company and what makes it interesting to you?
Yeah. Okay. I'm usually quite hesitant when sharing names that I invest in, and the reason for that is people tend to look for stock tips. They want names that are sure win. So before I get into the discussion, I just want to caveat by saying, right, there's no guarantee that any single stock name that we mention here on this session will do well. There's no guarantee it will do well, right? I mean, investors like you and I, we know that investing is about portfolio management, right? It's about investing in a group of companies that will set our entire portfolio up to do well with the highest probability, but no guarantee that each stock will do well, right? So this is the caveat that I'll say. Yes, so Robinhood is a company that I've been invested for about a year plus. It's basically an online brokerage platform. Your viewers might be more familiar with other platforms like Interactive Brokers or Tiger. Robinhood started out in the United States. And why I favor Robinhood more than the other brokers is because of its long runway for growth. I think Robinhood's growth has been pretty consistent, over 20% over the past 9 quarters. There's a long runway because the big group of its clients are in the millennial group. So clients that are now coming of age, having graduated, starting to work, 20 plus, 30 plus years old. And as this group matures and as their earnings power increase, as they move up their career ladder, their disposable income and discretionary income to invest will get larger. So I'll give you some numbers just for reference, all right? The average account size for Robinhood now is about $7,000 US. Compare this to, say, a Charles Schwab. I just look at that, depending on which sources you look at the internet, Charles Schwab average account size is about $220,000, $230,000. Some even quote for their higher net worth accounts is about $550,000 per account. So if you look at Robinhood's $7,000 per account for its millennial age group, I think there's a huge runway for that to grow. Yeah, and it's also started as a mobile-first platform, meaning it's only suited for a certain group of casual investors, I would say. It's developing new products. For example, it just recently rolled out its desktop program software, and I think this will start allowing it to attract more serious traders, people who want to be more active in the market. And so over the next few years, I actually anticipate Robinhood's revenues to grow tremendously as the profile or the maturity of its clients evolve over time.
Actually, how they make money? Because I recall their core offerings, right? They offer people to trade on their platforms, but then they offer free trading. I'm not sure about the full details, but I know, let's say for the basic one, if you just trade shares, probably it's zero commission. Then how do they earn money? Where's the bulk of their revenue?
Some of their products, they actually charge a trading commission for it. So for example, options, futures, and all that they trade. I think how they got to fame was free trading commissions for equities. And in return for that, they actually sold the trade flow data to large market makers, market makers like Citadel and all that. That's one part of how they make their revenue, selling that trade data. Another way they make money is through margin, so lending to allow people to buy on leverage. That's another way. And I think a third way is the interest that they earn for deposits that are in their account. So there are a few ways. And I think they also started issuing more money products, meaning like credit card products, debit card products, which is apparently gaining quite good traction in the US market. So these are the 3 or 4 ways in which it's earning revs.
Yeah. And they also have a clear strategy of trying to break into all these high net worth segment, right? Because I recall I seen them making presentations that they are offering more product and services to consider those affluent customers. Say for example, I think they have this, I think this is only in US because they offer like, if you have the platforms, you can just on demand asking for cash and someone will deliver the cash to you. This kind of like interesting new services that they're providing. And then I think they also have some AI services, like really professional, how to say, advisory on money management. I don't know how it works, but it sounds like something that usually only available to those high net worth clients. And usually, I think that traditionally people have this kind of services done by human, but now they're trying to leverage on AI or on those things, right? Do you pay a lot of attention to all this offering, or is it like these are not the stuff that is important, just core business?
I do. Probably not everything you mentioned. Some of the things that noteworthy to me is how they attract the high net worth individuals. They specifically say that if you are transferring money from another brokerage, so like Fidelity or Charles Schwab, they actually give you a cash payout of up to 3%. So, for example, if you're bringing over $1 million, they give you free cash of $30,000, which is actually quite attractive, right? If you think about it, I mean, you have to put your money somewhere, you know, why not put it at this platform that's giving you free trading commissions and is giving you free $30,000? I mean, whether you're high net worth or not, I think it's quite attractive. And from Robinhood's perspective, I think they actually shared some of those break-even numbers. I think it takes them roughly 12 to 15 months, and I need to check this against my notes again, but it's not a long period of time for them to break even by offering these cash incentives for people to transfer their money over. And I think that's a good way to increase your average account size over time. And these are also people who tend to be more active in the market, so they generate more revenues for you as well. So I think it's a good way. You also talk about, you know, instant cash and all that. I'm not exactly sure which program you're referring to, but I know they are evolving from just being a simple brokerage account to a money management account. So I talk about credit cards, I talk about debits, different savings account and all that. So they're trying to be the money app for their investors, you know, like a one-stop app. So I think this will open up new areas of revenue for the company.
Yeah, very interesting. And how do they, I mean, I need to ask about the competitions because I feel that like in this business or brokerage, right, it's still quite competitive, right? I would give a few examples. Let's say even the local one, people are using Moomoo, for example. And I think that these kind of apps, right, actually quite well made. Because I myself, I don't trade using Moomoo, but I observe myself using their app a lot because of the informations they bring provided, real-time prices, quite a lot of like informations is available on their platforms, and it's really well made. No? So I'm just thinking that actually it's quite competitive also in this space. They try different creative ideas. Say, for example, even allows their user to write blog on the sites, these kind of things to drive more traffics, right? So I just feel that it's quite competitive. Don't you think that this is a concern?
I think there are many service providers, brokerage providers in the industry, but this doesn't necessarily mean that the participants cannot earn good money or cannot grow well in this space, right? I mean, the amount of cash that's out there for people to invest, if you look at earlier years of the brokerage scene, I think this was probably dominated by the banks. So there were also many banks who offered such services. But I think the banks have kind of fallen behind in terms of the capability that their platforms can offer. And these new generation brokers like Interactive Brokers, Robinhood, probably Moomoo, have stepped up to offer much better products. My sense, and this is me looking at the financials of some of these players like Interactive Brokers and Robinhood, my sense is there's still a long runway growth for these players, in spite of the fact that we feel it is quite crowded. But I think there's enough space for these people to grow. For me, when I invest, I'm less concerned about what the overall competitive landscape is. Of course, it's important to keep an eye on it. But for me, what's most important is that the companies continue to do well, right? And there's no running away from the numbers. We can say it's competitive, it's extremely competitive, but the company is growing 30% year after year. It must be doing something right. Conversely, if there's hardly any competition out there, but the company is growing at 5% a year, then that's not a company I want to invest in as well, right? So for me, it's more important to focus on company-specific performance.
Yeah, that's true. Sometimes it's the entire space is like growing just because of the stuff that they are able to do now that which they can't do in the past. Say, for example, how to leverage on the technology, and all these are the one that is doing well, right? And I see those traditional banks, if you expect them to do some creative kind of services, right? Sometimes it's like can't expect them to do that. Their core business is already like earning them money. They don't need to try hard. Also, they still continue to earn money, right? So that's why we see all the innovations happen at this startup or these newer companies that they have the DNA to innovate. Yeah, maybe we switch gear a bit from this Robinhood. But you want to talk about the other companies?
One more company I'll share is Hims and Hers. So Hims and Hers is basically an online healthcare and wellness company. There are a few things they do. They provide online prescription on a recurring basis to their clients. So instead of driving to a CVS or a Walgreens for people to submit their prescription, wait for the prescription to be filled and collect their prescription, they actually do all of that online. So you save a lot of time doing that. They also offer treatment for issues such as sexual health and mental health, which are issues that people may not be necessarily so comfortable going in to see a doctor physically to talk about such things and discuss such things, right? So now being able to do it remotely from a telehealth perspective is quite compelling in terms of what the company is offering. They also offer wellness products. So for example, skincare, healthcare, and all that. So it's a company that basically is moving the healthcare and wellness space into the online world. Yeah.
So actually, is that from the founding time is already this kind of business, or is it like they pivot from some other business before?
As far as I know, since they've listed, it's always been this business. I probably don't remember as far back as when they first incorporated whether it was like that. But as far as the time period that I've known the company and back to IPO days, they were such a company. What I actually like about this company is that revenue is accelerating. So over the past 4 quarters, revenue has accelerated from about 46% a year back, and every quarter they've been accelerating. Now it was in Q1, the quarter that just passed, it was over 110% year over year. And I really like these companies that accelerate revenue, accelerate earnings, because that kind of surprise tends to be rewarded by Wall Street when it actually happens. Earnings upside, earnings surprise. So it's done well. I mean, I've owned it longer than that, but it's done well particularly in the past one year.
Yeah. Is there any other things like, let's say, following their culture? Like what is any DNA that you like about these companies?
I wouldn't say culture is something that I look at specifically when I invest, because it's quite an intangible thing in terms of how it actually improves the company. But what I do like is focusing on how management is leading the company, how management talks on the earnings call. So I spend a lot of time on earnings call, listening to what management say and trying to pick out nuggets to get an idea of how they lead the company and all that. So Hims and Hers, for me, it's a company that is very progressive. When they go on their calls, it is quite clear that they are not satisfied with just doing what they've been doing. For example, what I just described to you. They actually in the past 6 to 9 months have been busy acquiring different parts that can make the company a much stronger company in the years to come. So for example, they bought a contract manufacturing company which allows them to manufacture generic drugs. So during the GLP-1 shortage that we saw in the past few months, the company that they acquired actually stepped in to produce the compound version. In the healthcare industry, they call it compounded drugs. So very similar drug composition to say Wegovy or Ozempic, but not exact same composition, and yet it's legal for them to sell these compounded drugs. So the manufacturing facility actually allows them to take advantage of temporary shortages in the healthcare industry, as well as drugs that fall off patent. The manufacturing facility allows them to then start producing their own drugs as well. They've also bought a peptide facility, and peptide deals with proteins, using proteins and molecules to come up with innovative solutions for the ailments that we are facing now in our everyday life, more customized solutions. So they're buying all these things that make them, to me, a very large healthcare player in the United States. So that's one thing that I really like about how forward-looking the company or the management is for Hims and Hers.
Is this considered like venturing outside of their core business? Because you mentioned they started out as like more like a telehealth companies, then suddenly now become drug manufacturing. Sounds like quite outside, right? Different, right?
I would say it is adjacent because with them being able to be telehealth and being able to fulfill prescriptions and all that, they're already in the healthcare industry. And then understanding the shortages in the industry allow them to take advantage. This knowledge that they have allows them to take advantage of it by having this contract manufacturing facility. So even I'll give you another example, GLP-1, which is all the rage now. But a lot of people don't understand how to stick to their treatment regime or the GLP-1 drugs, and still be able to maintain the muscles that they need for their daily life. So one problem in GLP drugs is that a lot of consumers who consume these drugs have a lot of muscle mass. So where Hims and Hers is coming also is to provide healthcare assistance to guide these consumers as they take their GLP-1 drugs. How can they maintain their exercise regime or their diet such that they don't have too much muscle loss, right? So would you say that is totally different from telehealth? I think it's quite adjacent. So I can see the company doing a lot of things that are adjacent. I'm not even sure I would call it adjacent to their core business, but adjacent to their current business. And hopefully over time, all these adjacent business lines become part of their core business and they become a stronger company.
So speaking of all this GLP, right, do you invest in companies like Eli Lilly and Novo Nordisk? I think these are the two main ones, right, currently competing in this space, right?
Yeah. I was invested in Novo Nordisk. I still own a very small percentage, I think 1+% in Novo Nordisk. I used to invest in Eli Lilly as well. So I sort of understand this space. I no longer have a significant allocation to this space because I think the landscape has changed quite a fair bit. If you say, I look back at 18 months back, I think Eli and Novo Nordisk Solutions were the only two players in the space. Now there are more competing drugs that are proving efficacy in phase 3 trials. So I think there was going to be more competition coming up. And also some of these companies, so for example, Novo Nordisk didn't really manage the supply of its drugs very well. They had some big boo-boos, like they restricted the availability of their drugs because they were afraid that they couldn't meet the entire demand. And that gave them a lot of backlash in terms of the image of the company. They also didn't ramp up production as quickly as was needed in the market. So that kind of caused revenues and earnings to decline as well. So Novo Nordisk has actually had more issues than Eli Lilly. Invested in this space, but no longer a significant position.
I actually have position in Novo, but I find also small positions just to learn about all this GLP space. It seems that these companies, they started out just doing diabetic drugs, right? Then slowly they have all their R&D really got into all this space and invent new drugs like GLP. To me, it's like a great invention because last time you only eat until you got the disease, then only you also use the kind of treatment. It's not really cure the diabetics, right? It's more like just help you lessen the effects, right? Yeah. Then now people can actually just taking some medicine and then referring to the GLP, and then they can just eat a lot less. So I do believe that actually quite a number of diseases actually come from how much we eat that cause all this disease. If we eat less, maybe it's healthier for all.
Yeah, I think it's a good thing. And not just disease, even weight issues, you know, the pressure you put on your knees, on your legs, your ability to travel further distances through walking, hiking and all that is all affected, right? So I think they are long-term, they are here to stay for the long term, but I think the nature of these drugs will change. So for example, a lot of them now are injectables. Not everyone is keen to poke a needle to their own body by themselves every week. So now you're talking about oral reform and all that. So I think the landscape will change over the next 6 to 12 months as well.
Already come out, right? News is out already. These are not like a secret.
Yeah.
Okay, good. I think enough for the companies discussions.
Sure.
I roughly know like your style when it comes to all these company discussions. You are looking for growth, looking for the management. Management needs to know how to grow their business. They need to know how to strategize basically. That's have a much better understanding. I want to like pivot slightly just to ask you, like, do you have any, let's say, like famous investor that you are following that influence you a lot when it comes to your investing? I know many people they quote Warren Buffett. I'm not sure about you so do you want to share more about like who influenced you the most?
I think over the years, and because I've been investing for about 20 years, different investors have influenced me at different stages of my journey. In the earlier days, it was Benjamin Graham, which no longer, his investing methods no longer work for me. So I would like to think that I've evolved in that time. I think in the past few years, there are a few investors who have influenced my investing. One investor is actually a friend, a retired doctor. He's a private investor. He's based in the US. His name is called Saul Rosenthal. I actually met him through one of the Motley Fool forums boards, and I found out that he had an incredible track record of over 30% CAGR over the past 40 years. So as a private investor, I thought that was very impressive. So I reached out to him. I had chats. I met him online. And I think from him, I learned how to analyze growth companies better. What are the metrics to look at and all that. So now he's over 80 years old and he recently retired from full-time investing. I think he retired a couple months back. Yeah, so I learned a lot from him. Recently, I also started learning from some of the traders. So technical analysts, for example, like Mark Minervini. I find that while I cannot relate to a lot of things that technical analysis teaches, there are some parts which I can take out from what they teach to apply to my own investing. So maybe like 5%, 10% of what they teach, I find that I can resonate with and I can relate to. So, I sometimes use things like moving averages or and certain indicators to help me get a sense of whether the market is about to bottom or has already bottomed or is near a peak, about to turn. Of course, it will never be 100% correctly, but I think these are all tools that I use to give me a higher probability of succeeding in the stock.
But it doesn't mix with your own investing, right? Your investing is still fundamentals, individual companies analysis. Then it's only like when you wanted to get in or out of the positions, then you use a bit of these techniques to help out a bit. It doesn't, you're not like, looking at this company, all good. Then after that, just because it breaks the technicals, then you just get out. Not like that, like not trading, right?
Yeah, I mean, you're exactly right to say that I am predominantly a fundamental investor. So I would say if you had spoken to me about 3 to 4 years back, I would say I'm 100% fundamental analysis. Right now, I would say I'm probably 95% fundamental analysis, meaning like what you just described. I analyze the companies, do my due diligence and all that from a fundamental perspective. And then that last bit, when it comes to trading around positions, like when to get in and maybe when to get out, I sometimes use technical analysis and I found it helpful. Of course, when I was experimenting with technical analysis, there are times where I did certain trades 100% based on technicals, and I view that as part of the learning process, right?
Yeah.
You need to be able to try things before you know whether it works for you or it doesn't work for you. And I'm sure there are many technical traders out there who have systems that work very well for them. So my mind is not closed to these methods, which is why I need to experiment. But the important thing when it comes to experimenting is, of course, just use a very small part of your portfolio and then give it enough time to see whether it works for you or not. So there were times where I was 100% in technicals. And this is the past 2 years, 100% in technicals, but a very, very small part of my portfolio.
I think even it doesn't work, right? It's still, you learn something from there. I think that's important. For me, right, I did try before, like many years back, like just for fun tradings, and somehow I trade futures. So just within, I think a couple of weeks, I lost like $4,000. Then okay lah. At least I learned that this doesn't work for me. I'm not into that. So, but it's not like these are not the stuff that's like religious stuff, right? You shouldn't be too religious about it. You should try it out. Anything, right? Stock picking, technical analysis, anything. It's just that for me personally, I try out, and my takeaway is that okay, I really not built for these kind of things. I even try, I lost money, and then I lost small amount of money. 4,000 is not like, so big that I can't take it anymore. But it's just that in terms of emotional hit to me, right, personally, it's so big. Like, I mean, when it comes to investing, right, to me, $4,000 every day up down, I got no feeling. But when I trade, right, I lose money, then I cannot take it. I don't know, like, these kind of things, it hit us emotionally differently just because of how we operate. That's just my personal experience. But interesting to hear that investor like you also will blend in some technical analysis into your process, which I think is part of the process that you mentioned. It's like continuously learning and then continuously improving. If it helps, why not, right? So that's the...
I think one of the beauties of learning is that regardless of what you learn, even though you may not be ready to learn it, say 3, 4, 5, 10 years ago. So for example, for me, I started technical analysis in my very early days as an investor. And this is 20 years back. William O'Neill, his CAD Slim system and all the indicators he used and all that, right? And that totally didn't speak to me at that time, right? But 20 years later, when I review the same concepts and all that with new skills that I have, with the journey that I've gone through now, I can then think more independently about, hey, whatever I'm learning now, how can I incorporate into my current investing style, right? So the same material can speak to you differently at different times in your investing journey. And I think that's just the amazing part about learning.
Yeah, fascinating. Yeah, I just finish up the questions that I prepared before this, right? I think one of the last few questions that I wanted to ask is that talking about like education stuff, or talking about like average persons who are investing their own money. So do you think that investors should do this kind of like stock picking, or do you suggest to average person that they actually shouldn't do these kind of things if it is not their passion, right? Or let's say they don't have time, they should just do index investing. I think those are the most commonly offered advice to an average person. So in your thinking, right, how should average persons that is not like full-time investor deal with their personal investment?
I don't think there's a simple yes or no answer to that. I think you use the word average investor, right? And I think the definition of average investor can also be quite subjective. I think for the average investor who is willing to put in some work, I think stock picking can be rewarding, but of course it won't be easy. Like, I consider myself an average investor, and I was passionate for investing, right? And to improve my own investing methods and find out how to invest better. For people who don't wish to put in the effort, I would say an ETF, the Warren Buffett's advice of putting it into a low-cost ETF, I think will work very well for most people. Of course, if you come across a good fund manager, a good fund, and there are a few of these around, the average investor who's not willing to put in much effort investing can consider these funds. But I think to generally do well, there's no free lunch. I would say, having gone through this journey for 20 years, I would say there's no free lunch. You can't really be saying, I don't want to put it's in with anything you do. You can't say, I don't want to put much effort into this, but I still want to get 20-30% return a year, right? I think that's just not reasonable. You can't say, I don't want to put in effort into my work, into my employment, and I still expect somebody to give me $5,000, $10,000, $15,000 a month. Just just not practical, right? These are my thoughts for people who are looking to go into investing.
Yeah, because I'm thinking the challenges of, let's say, like picking stocks or be more active in the portfolio management, right? The challenges is quite different as compared to some other stuff. So let's say if I'm suddenly interested in learning how to cook, right? Then I go and sign up a course, pay a few $1,000s, and then spend, let's say, like 20 hours to learn about cooking, different lessons, right? I can reasonably expect that by the time I finish this entire course and then go through the lessons, right, I will know some knowledge that I don't know before, and then I know how to cook certain dishes that I don't know how to cook before. These are kind of like, high certainty one. You don't expect that, oh, by the end of it is still like zero, you get nothing, right? But when it comes to investing, say for example, like recent week, it will be like, for example, all the wars, right? Israel strike into Iran, and then Trump say crazy things about like politics, and then maybe if we just go back to April, that time it's all about trade war. You need to become like a trade specialist. You need to study all these things in order to navigate. It just seems that by I say average person means that, let's say if you belong to 70% of the public, right? Meaning that there's nothing, none of your experience set you apart from majority of people's, right? Then people kind of like struggle to process this kind of information. So that's why I would feel that, is it like just better for people just index and then close their eyes instead of like go through all this learning? Because there are people who spend quite some time to try to do it themselves, and then by the end of it, it's still not as good. The result is not as good as like just track along the index, right?
I mean, you're right to say. I think investing is an activity that is not very formulaic, right? It's not like you do step 1 to step 10, then you master it, you will do very well, right? Because there's just so many factors involved. There's human psychology, there's the participants or the behavior of the other participants in the market, and like you say, all these unexpected black swan events. Black swan, but happen every year, every 18 months or so, right? And how do you react to those? I mean, in my investing journey, and even though I've been investing for quite a while now, I feel that there's probably still a lot more to learn as an investor. And I look at my journey, every 5 years, I've actually improved a certain thing on my investing. For example, I think in the past 2 to 3 years, I mentioned to you about technical analysis. I've also improved my portfolio management style as well, learning from speaking to different people and learning how they do things and all that. So it's a constantly evolving process. Like you said, in cooking, maybe you spend a certain amount of time, the 80-20 rule will apply, right? You'll be able to get to maybe 80% standard. You maybe can't get to fine dining or Michelin star level, but you do a decent job. Investing, and even for the earlier years of my investing career, I felt that I was doing so many of these things correctly, but I was not getting the results I wanted. And then the switch, say for example for me, the switch from moving to from the Singapore market to the US market suddenly allowed me to see huge changes in my investing performance. So small switches like that, which you can't tell an investor at the start of it saying, oh, just only look at this market, don't look at that market, right? It also has to, your own investing style also matters in terms of which market you choose and all that. For example, if you really believe in deep value, low PE, low PB companies, then maybe Singapore market or Hong Kong market might be very suited for you, which I know investors who have done very well in these markets, right? But my investing style and my journey up to that point, when I realized that the Hong Kong market and Singapore market was not suitable for me, were actually skill sets that I had developed that were more suited in the US market. There are just too many variables in investing, I think, to make it a very formulaic process for anyone to do well.
Yeah, there's the learning part, and then there's the self-discovery part. There's experience need to accumulate, and continuously learnings are basically make one better. That one cannot skip.
Exactly. And I don't want to make it sound like it's very daunting, right? For anyone who wants to try their hand at investing. What I will always tell people about investing is that it's simple, but it's not easy. Right? Right? Yeah. We all know there are certain things we need to do. For example, we need to learn basic financial accounting. That's the simple part,
Yeah.
right? But then how do you apply what you learn in accounting to analyze these companies? Which are the metrics you focus on? Which are the metrics you calculate? Like you mentioned ROIC and all that. You may use it, I may not use it, right? But we all learn the same thing from accounting.
Yeah.
So different things like that.
Comes to closing questions, I want to ask something about education, especially for younger generation kids. I know that you have been sharing some. I mean, previously I've seen you shared about how to teach kids about investing, maybe personal finance. How do you actually kickstart this with your kids? And just for audience context, how old are your kids there?
So I've got 3 kids. I've got a 16-year-old, a 13-year-old, and a 5-year-old. So wide age range. I started having conversations with them about money, not so much about investing actually, but really just money to begin with, right? Because I think that's a basic building block when it comes to finance. Maybe about 3 to 4 years back. And just talking about the very basic things about money, which is the importance of money, when is it important and when is it maybe not so important? This part, I think, it was something that I wanted to address it very early on in their journey. And then the different things you can do with money. For example, earning, spending, saving, donating, your own insurance and all that. So the different aspects of it, we covered all of it. When we talk about earning, we talk about jobs, talk about entrepreneurship, talk even about marrying into rich families, things like that. And then spending, we talk about the concepts of needs and wants. It's important, which I think many kids, as they grow up, they find it maybe a bit difficult at the beginning to differentiate between needs and wants. That's that. Then we talk about donating, how we are here to maybe serve a bigger purpose. While we may benefit from what society has given us, how do we eventually give it back to others? So I think these are important topics to have. And you notice that all of this haven't even covered investing yet. And then in subsequent sessions, we then talk about the different companies out there. Of course, we start with companies that they are familiar with. So for example, McDonald's or even YouTube and Google, right? And I think these are, especially YouTube, Google, I think a good company to bring up to discuss, because how they make money is actually not intuitive to many people or who are not so familiar with investing, because all they see is search. So I think these are good conversations to have. As they grow older, I intend to do more things like introduce them to basic accounting. Of course, I won't be the one teaching it. I will probably be vomiting blood if I do that, right? But the beauty of the internet now is there are places like Udemy who can have basic accounting course that they can sit through at the comfort of their own home. So things like basic accounting. And then where I might probably step in is, now that you know the basics, how do you use that information to apply it to your investing, right? And then of course you talk about reading as many financial statements, not financial statements, but just reading annual reports to understand what are the type of companies out there and what is a so-called, as we said earlier, high quality company, not so high quality company. I find that can only come with having gone through many, many companies, right? If you've just only read annual reports of 20 companies, I think it's quite hard to have your own mind about what is high quality, what is not high quality. But if you have gone through the annual reports of 200 companies, then maybe you have a better idea. So things like that, I think I will gradually introduce to them. But I think they're a bit too young. And of course, the worry is, of course, to load them up too much and scare them away before they even develop an interest, right? So for me, where my perspective is, my kids don't have to follow my journey because there are many different ways to make money. Investing is not the only place, and making money also should not be a huge priority in my kids' life. I feel it's not that big a priority in my life, but really your fulfillment, the things you do in life, right? You can do it through entrepreneurship, you can do it for helping people, or even as being a highly paid employee, that's perfectly fine as well. So for me, I would say I don't force my kids to go down that route. My son, who is 16, he has recently reached out to ask me if he can learn investing. And when I say, okay, I'll share more with you, they need to really want it before I will really, start loading them up with more materials and more things to do. Ultimately, it's the passion that they need to have.
Yeah, definitely. Have they asked you any questions that's difficult to answer? Maybe not like adult kids, maybe when they were young. Have they asked you questions that you struggle to answer?
Many. And like I said, the topic of money happens quite frequently in my family. So recently, my son got quite upset with me because he wanted to buy an iPhone and he wanted to use his own money. So using his ang pao money and all that. And I had certain thoughts about it, which I encouraged him not to buy. And he got quite upset with me saying, hey, it's my own money, why can't I do whatever I want with my money?
Yeah, good point.
I think he has a good point, right?
Yeah.
He has a good point. So my answer to him was that, yes, it's your money. But at the same time, I would like to think that because I'm your father, I can give you some thoughts of how you should or should not spend your money. The decision is ultimately yours. But when you're 16, you may not have the maturity to know what to spend on and what not to spend on, right? And while you have the first 20 to 25 years with me, I would like to have this opportunity to share with you my thoughts on how you spend your money. Because once you leave home, you truly are fully autonomous in the way you spend your money. And I have zero way to influence that, right? So just hear me out what I want to say about your iPhone. Whether, at 16, should you be spending $1,500 on a brand new phone when your dad even doesn't have, I'm using a 4-year-old iPhone, right? I don't do that, right? Because it's not a necessity, it's a want. So after speaking to him and all that, I think he sort of understood. And I think kids are such that, and he's of a certain age, of a certain maturity where he will sit down and listen when you're speaking logically to him. And so after that, he decided not to buy the phone. So I didn't force him, but I shared my thoughts with him. And so I find at this age, especially when they are teenagers, it's better to just have a mature talk to them. Whereas previously, if let's say my daughter, when she was 10 years old or 11 years old, I would just be more firm and say, no, you can't buy that. And there's very little pushback, right? But now as teenagers, you can't really get away with that anymore. So the way of parenting and talking to them, for me, has evolved as they grow older.
But let's say if he discussed with you, then in the end, he said, I want iPhone. Would you upset?
I think I would be upset, but I feel that it is a lesson that I cannot shove it down his throat. And I think it is a lesson that they will have to learn for themselves. So if I look back at my own journey, I also grew up spending money pretty freely. And it was only when I got to a certain age where I realized that you can't continue be doing that and still have a good financial future, right?
Yeah.
And that's when you start tightening your belt. So I think it's also an experience. While I would be disappointed, I think I wouldn't be too overly concerned. As long as we share with them the right things, eventually I think logic will prevail. And hopefully, as they grow up, they make the right decision. If they end up not making the right decision and their lives suffer for it, you can only say that you've done your job as a parent, right? But I really, there are certain things where you need to be forceful in parenting, I find. But when it comes to spending their own money, I find it quite difficult to be forceful. In that, right? So I find it's more conversation style when it comes to talking about money and all that.
So now it's like, okay, because he's still not fully independent, in a way you still talk about the reasoning and stuff, but you are kind of like a bit more forceful. But once he just earned his money, then he just want to spend, I think it's a lot harder already. But that type is already like full adults, right? No longer just teenager, right? But I believe that teenagers' age should be, I mean, they will start to be more, how to say, a fight back, more rebellious, right? That's the word now.
I see some of that behavior in my kids, but it usually works out pretty well when we have sit down and I share with them my perspective. I usually start off by sharing my experience growing up, and they'll be interested to hear what I actually went through as a kid, the difficulties I had and all that. I was recently reminded by a saying I saw online, which is telling our kids that we are able to teach you now not because we are so great, but it's because we have walked that journey before and we have made the mistakes that we potentially see you making, right? And we are trying to help you avoid that mistakes. And I think if you come from that perspective to share that you are as fallible as them, failable, you don't seem so perfect that you're always just having a one-way directions, giving them directions one-way traffic, but have a conversation with them, hear them out as well. I think or at least I can say for in my family, it has tended to work out well. Of course, you get parts of that rebellious nature, that pushback, that retort, and all that, right? And you just have to let them know there's really no place for that in the family. And then just sit down when tempers have cooled and just have a proper chat. That has always worked well for me. Although it's not easy, it's one of those things again.
Simple but not easy.
But not easy, right? Especially when it comes to human emotions and all that. Yeah.
But I feel that you are the type that's quite patient already, like with friends. I mean, explaining stuff. I don't see myself as so patient to chat with them now. But of course, when the moods are okay, I think sharing, chatting, explaining things, those are all good. But with kids, I think the communication is totally different as compared to like just friend and friend chatting. It's different. You need to fit their styles also, make sure that they can absorb, right?
Yeah. I mean, it's very different. And I think how you speak to them also, your motivations matter a lot. So I wouldn't say I'm super patient. There are times where my fuse is pretty short as well. I mean, we both have kids and we understand how frustrating it can be, right?
Yeah.
But for me, I guess where there are important messages that I want them to internalize and apply to their own lives, then I do make the effort to sit down and have a chat, whether is it in a car ride with my son, at a dinner table with my daughter, or just the entire family chatting about a certain topic, right? I think it's important enough that we do set aside time in our family to talk about things. So that's what I try to do. In my list of reminders, other than the work that I have to do, like on my iPhone, I also have reminders of talk about this topic to which child. So then it's always on my to-do list and I never forget it, right? So I use all these tools to help me as well.
Wow, so structured. that's very important. Yeah.
Engineer,
that very put it to good use. Maybe not so much about the details about aerospace, right? It's more on the thought process that is helpful, right? And it will be benefits from that for long period of time now.
I don't know if just now you asked me a question about growth and value. I don't know if you are interested to talk about it, because I do have certain thoughts, and it's a question that I get quite frequently, whether am I a growth investor or a value investor. And I think maybe you might have formed your own conclusion from our discussion earlier.
I know. Good answer.
So what's my answer?
Answer is definitely growth. I mean, just like definitely you, based on my understanding, you won't go for a company just because the PE is low, expectation is low, hence buy this company should be okay one. You won't have that kind of feeling that you are really more towards looking at the companies and just pay more attention to the quality. But that's the part that also we need to bring in the qualitative judgment because we can debate all these, right? Because when that stuff is qualitative, sometimes not so easy. But seems to me that you pay more attention to growth. Am I right on that?
I do, but I think I would answer that question in a different way. I would consider myself a growth-oriented value investor. And that for many people might seem like an oxymoron, meaning you're growth, but you are also value at the same time. How can that work, right? And I think many people who have that thought actually, for me, have a very wrong impression of value investing. Their bad impression of value investing comes from the Benjamin Graham days of value investing, investing in low PE, low PB, or even cigar butt investing, right? But if you look at the definition of value investing, it's actually all about buying stocks at a price that is cheaper than what you think it's worth, right? So it's relative price versus what you think it's worth. Nowhere in value investing talks about low PE and low PB. So for me, I think being a growth-oriented value investor is actually it's not an oxymoron. Basically, I look at companies that are growing well, both top line and bottom line, but I also like to pay a low price for these companies. Right? A price that I think is less than what they're worth in the future. And, even if you look at an investor like Warren Buffett, many people view him as a value guy, which is correct, value investor. But if these people view him as a low PE and low PB guy, then I think you and I know that that's wrong.
Yeah.
Right? He has not been a low PE and low PB guy for the longest time. And I think for him, the pivot came when he bought See's Candies with Charlie Munger, right? Yeah. He paid a very high PE at that time, which he thought it was ridiculous. But that was the one company that made him realize the value of a strong moat and a company that can grow tremendously year after year, right? And so Warren Buffett, in my opinion, has actually been quite a growth investor for quite a while already. Value investor for quite a while. He invested in Apple maybe about 10 years back when it was still growing well. When he bought Precision Cast Parts, it was also growing well, high PE company. And Buffett has come out to say that growth and value are actually not separate styles of investing. They actually join at the hip, right? So I actually find it my mission really to sort of help investors understand that value investing doesn't have to be different from growth investing. I get this so often that people say, oh, you're growth, so you don't really believe in value investing. And then I go on this 10-15 minute discussion on why that's not true, but I thought it's just worth pointing out that it doesn't have to be either or, right?
Yeah.
Both of them, like Buffett said, can be joined at the hip. So I thought just an interesting thing to point out.
Yeah, definitely can relate on that now, because people tend to see, like you said, tend to see that, oh, if you are investing in 30x PE, don't call yourself value investor, right? I mean, this is quite common, but we all know that like the growth itself is the quality of the companies, at least at the moment, right? If they're able to grow at a high rate, that means they are doing something right? There's some quality to it. That's why all these factors, they are kind of like linked to each other, and we shouldn't just classify companies just based on like the metrics that you just mentioned. And I think that one is like one of the largest misconceptions of so many investors. They tend to overlook. And if I am to label Warren Buffett, I wouldn't even label him as like value investor or growth investor. I would actually label him as quality investor, because if he's able to hold companies like, for example, like Coca-Cola, See's Candies, all these for so many years, right? If you talk about the typical low PE kind of metrics to label value investing, I would argue that why he didn't sell all these companies, because if you buy certain shares, right, for sure there will be a period where the PE become high. Let's say like Costco, high PE, if you have the exposure, you should sell it, right? It's no longer value investing anymore. But when they can hold on a companies for so long, I think it's like what is keeping them holding on is actually the quality of the business, and they can see the quality as something like, it provides some certainty, and it provides some you can call it many ways to call them, but essentially these are companies that they are happy to hold long term. Is quality investing. I think that's a lot closer. So you can see that there are different parts. Not everything black and white now. Yeah.
And I think Wall Street doesn't help. They also like to promote this narrative of growth versus value, which is just so misleading. But hopefully both of us will spread the word, and investors will be able to understand growth and investing better.
Yep. I think that's a good close to our discussions. Thank you so much, Cedric, for willing to come to my show here, having chit chat. We'll share this to our community as well, just to let them learn more about you and about your investing stuff. Thank you so much.
Thanks a lot, Bunty. Glad to be here. Bye-bye.